Nigeria's stock market lost $3 billion, then gained it all back in 48 hours. Is this resilience, or are we one policy tweet away from the next meltdown? Good morning and welcome to another power-packed episode of Business Week. This week, Microsoft is dropping $10 billion on Portugal's AI dreams, while in Washington, the Senate finally remembered how to keep the lights on and ended a government shutdown. Madagascar is planning to borrow a record $1.9 billion next year because nothing says post-coup stability like aggressive borrowing. And in Nigeria, the NUPRC, the upstream regulator, is gearing up to open up its 2025 oil licensing round in December. In the markets, gold is back above $4,000 and looking smug, while the Fed's December rate cut odds have nosedived from a confident 95% to a coin flip 50% in just 4 weeks. Meanwhile, Michael Berry, the man who famously bet against the housing market in 2008, has ghosted the U.S. Securities and Exchange Commission, pulling his hedge fund registration and cryptically announcing his on to much better things. What does he know that we don't? But the wildest ride this week was on the Nigeria exchange, where a single policy announcement seemed to trigger a $3 billion wipeout on Tuesday, only for a hurried government U-turn to spark the biggest rally in nearly 2 years by Wednesday. Talk about whiplash. Later, I'll dissect this market drama with Arnold Dublin-Green, CEO of RC Asset Management at Renaissance Capital. Now, if you missed the big business stories of the week, don't worry, I've got you covered. I'm Rolake Akikugbe-Filani. Let's dive in. As always, we'll start with a look at global energy commodities, and Brent crude, WTI, natural gas, RBOB gasoline all had a pretty fantastic week, seeing gains week on week from the previous week. Of course, the biggest gainer here was natural gas doing quite well, and of course, RBOB gasoline at 3.09%. Let's take a look at equities markets, because that's really the talk of the week. Now, you're seeing a bit of red here, but actually, we're going to be discussing what happened on the NGX during the week. It was quite a historic one. But the all-share index did close the week down week on week last week, even though we did see a rally on Wednesday after the initial market rout. So closing at 1.68% up. Number of deals were still down. We haven't seen a full recovery yet, despite all the drama midweek. The volume of shares traded did recover significantly. No surprises there following what happened on Tuesday. And equity capitalization of the stock market was down week on week by 1.57%. Let's take a look at stock markets from elsewhere around the world. First of all, Johannesburg was up by 2.87% to close the week at 111,973.2 points. Accra was also up by, look at Casablanca down there by 3.23%. Similar bearish sentiment there on the Nairobi market to close the week at 2.42%. Let's take a look at Wall Street. Wall Street was up week on week. Markets there anticipating what the Fed will do at the next policy decision. Although we're seeing a reduction in the odds, as I mentioned at the top of the show, going down from 95% to 50%. Odds of a rate cut are down. What does that signal? Markets still trying to make sense of data coming out of the US economy, but at least the government shutdown has ended, which would have buoyed markets this week, and all the major indices we watched there, Nasdaq Composite and Dow Jones Industrial Index, finished the week on a high. Let's take a look at my top picks from around the world. Well, the first story here is that the IEA has somewhat been forced to backtrack on its forecasts, doomsday forecasts, some might say, about peak oil, now saying that oil demand is set to rise to about 115 million barrels a day by 2050. Interestingly, we saw some reaction from OPEC to this backtracking in analysis from the IEA. And OPEC says that the IEA's forecast has finally had a rendezvous with reality, calling the IEA agency accusing it of pushing an anti-oil narrative. Now, the IEA is saying that its new analysis is now based on not so robust demand for electric vehicles, a slowdown in demand in China, which has been compensated for by regions such as Southeast Asia. India is going to be a key center point for demand, and Africa is also on the map with about 1.2 million barrel a day increase in demand from the African continent by 2050. So the IEA there sort of singing a new tune around global oil demand and moving away from its traditionally peak oil forecasts. Now, the US Senate has finally passed a bill to end the government shutdown. It was the longest government shutdown, 41 days recorded in US history. Now, this bill was passed with a majority vote in the Senate, with some Democrats getting on side to support the Republicans. There's still a question, an outstanding question around the Affordable Care Act. Subsidies under that Affordable Care Act are due to lapse this December. And if they are not renewed, it means up to 24 million Americans will face a doubling in their insurance premiums, while about 15 million Americans will lose cover altogether. The Republicans in the House have promised a vote on that specific issue come December. But I guess good news for America, because we did see some impact on the housing market, on the job market. That shut down and everybody's back to work if you work for the government. Now, NUPRC, Nigeria's upstream petroleum regulator, has announced during a conference held in London called the 1 million barrel a day, additional 1 billion barrel a day investor conference, that it will launch its licensing round for marginal fields from the 1st of December. The last licensing round was in 2024. And this is interesting because the government has a plan to increase Nigeria's production by 1 million barrels a day. We're seeing peak oil production this year in Nigeria at about 1.8 million barrels a day, compared to peak oil last year at about 1.4 million barrels a day, although October figures are showing production of around 1.4 million barrels a day. So NUPRC there has actually also this year approved about 46 field development plans. And the whole idea behind this licensing round, due to launch at the start of December, is to really look at developing discovered but not developed fields, fallow assets, natural gas assets as well, helping to leverage and really take advantage of the presidential directives and reforms in the oil and gas sector, which have helped to attract investment into the space. I will be watching that one closely, very personally. Now, Microsoft is to invest about $10 billion in the Sines coastal region of Portugal in an AI data center. It's going to be deploying over 12,000 GPU graphics processing units developed by NVIDIA. It's going into this investment in partnership with a British AI company and NVIDIA. And this will be the largest such investment in European data infrastructure for AI. And it's part of the Digitizing Europe initiative that Microsoft started in April last year. Compared to its previous investments in Spain, this is a record amount of money. And the whole idea is that the Portuguese government also wants Portugal to become a hub for AI in the European, on the European continent. And finally, Madagascar plans to increase its borrowing to about $1.9 billion by next year. If you recall, late last year, the former government was toppled in a coup following protests over electricity and water shortages that then led to military action against the sitting government. And despite Madagascar being kicked out of the African Union as a result of that unconstitutional change of government, the country is still engaged with external parties for financing and borrowing. Now, the interesting thing is Madagascar is actually a major producer of global vanilla, and it controls about 60 to 7% of the world's vanilla harvest. We're also seeing US companies take and its strategic interest in the country due to its reserves of critical minerals. So there is some strategic significance for Madagascar as an Indian Ocean country in Africa. But this borrowing does raise concerns about how the government does ultimately intend to service that debt. And that's it for my top picks from around the world today. Now let's take you to some of our other top stories from around the world. First, good news emerging yesterday. S&P Global Ratings has upgraded Nigeria's outlook to positive from stable, reaffirming the country's B-B rating. The agency says Nigeria's sweeping fiscal and monetary reforms, including the removal of fuel subsidies and FX controls, could boost growth and investment over time. But it also warned that risks remain, especially around oil price volatility and policy execution. The Tinubu administration has hailed the move as a sign of growing investor confidence. Now, Odds of another quarter-point interest rate cut by the U.S. Federal Reserve next month slumped on Thursday following hawkish comments from policymakers and a Wall Street sell-off driven by sliding tech stocks. According to the CME FedWatch tool, traders now see just a 49.6% chance of a 25 basis point rate cut in December, down from 62.9% a day earlier, 69.6% a week ago, and 95.5% a month ago. With limited economic data due to the recently ended government shutdown and concerns about overstretched valuations in mega-cap tech stocks, traders have pulled money off the table, sending the S&P 500 lower. Meanwhile, Fed officials have leaned decisively hawkish. Gold rose sharply on Monday during the week, soaring back above the $4,000 100 mark in the global commodities market. The yellow metal gained 2.88% on the day and extended its rally to Tuesday, trading around $4,130 per ounce ahead of London's pre-market opening. This surge has lifted gold's month-to-date performance to over 3%, marking a solid comeback after a late October pullback. China's slowdown worsened in October, dragged by soft consumer demand and a deepening property downturn, with the long holiday period further denting factory activity. Fixed asset investment, which includes real estate, contracted 1.7% for the first 10 months of the year, steepening from a 0.5% decline in the January to September period, data from the National Bureau of Statistics showed on Friday. Analysts polled by Reuters had forecast a 0.8% drop, but the last time China recorded a contraction in fixed asset investment was in 2020 during the pandemic, according to data going back to 1992 from Wind Information, a private database focused on the country. Michael Berry's Skion Asset Management has terminated its registration with the U.S. Securities and Exchange Commission. The change took effect on November 10, according to a SEC filing. Berry, who rose to fame for his 2008 bet against the housing market in the U.S., posted on social media that he's, and we quote, "onto much better things," November 20. The hedge fund manager has repeatedly warned about market exuberance, recently posting an image from The Big Short with the caption, "Sometimes we see bubbles." Interesting there. We'll be talking about that a bit later in the show. Guinea in West Africa plans to launch its first sovereign wealth fund by the second quarter of 2026 with an initial $1 billion. Its planning minister said as the West African nation moves to leverage a flood of revenues from its giant Simandou iron ore mine. The fund will channel resource income, including from the Simandou project launched this week, into long-term investments that will finance education, infrastructure, agriculture, and industry, cushioning the economy against commodity price shocks. The CEO and president of the Dangote Group, Aliko Dangote, plans to invest up to $1 billion in Zimbabwe to develop cement and power plants, as well as a fuel pipeline. Nigeria's billionaire businessman Dangote signed an investment agreement across industrial and consumer goods, as well as extractive industries, with the government of Zimbabwe, led by President Emerson Mnangagwa. The Dangote deal with Zimbabwe comes after the Dangote Group made an initial attempt to invest in Zimbabwe back in 2015. Analysts warned earlier this week that a newly introduced capital gains tax that was actually set to take effect from January 1, 2026, would negatively impact investments in Nigeria and affect the country's macroeconomic stability. They argued the policy was ill-timed, particularly for venture capital, real estate, and other key investments, sparking fears that portfolio investments would rush to sell assets before year-end to lock in the existing 10% rate. The panic triggered, as we saw earlier, sell-offs that wiped out roughly 1.8 trillion naira in market value on the NGX over just 4 trading sessions. Nigeria's finance minister, Wale Edu, later promised a review of the capital gains tax, with markets eventually recovering to a 2-year high. The Nigerian Midstream and Downstream Petroleum Regulatory Authority has stated that the proposed implementation of the 15% ad valorem import duty on imported premium motor spirit and diesel is no longer in view. According to a statement posted on its X handle on Thursday, the director of the Public Affairs Department of NMDPRA, George Eneita, said it should also be noted that the implementation of the 15% import duty on premium motor spirit and diesel is no longer in view. NMDPRA also assured all that there is an adequate supply of petroleum products in the country within the acceptable national sufficiency threshold during this peak demand period. Nigeria's central bank governor, Yemi Cardoso, declared that nobody has a monopoly on the economy, stressing that this economy belongs to us all. Speaking at the annual CBN Executive Policy Seminar in Abuja, Cardoso said the progress achieved over the past 2.5 years through bold reforms must be protected. He warned that the attitude of, and we quote, "I am fine, others can sort themselves out," end of quote, will not sustain growth, adding that systemic weakness ultimately affects everyone.